You're losing money on every AUM client you acquire. I know that sounds dramatic, but let me show you the math most advisors have never actually done. Say you net 70 basis points after custodian fees and platform costs, and you acquire clients for $2,000, right, in acquisition costs. That means you need $285,000 in assets from one client just to break even in year one. Not profit, not growth, break even. And if you're thinking my average client is bigger than that, okay, at $500,000, you're still waiting 7 months just to break even on one client. Here's the part nobody actually says out loud. This isn't a marketing problem. It's not a lead problem. It's an economic problem baked into the model itself. So what if you could flip that sequence entirely? What if you could put $1 in and get multiple dollars of profit back on the first transaction? That's the cash flow flywheel, and it changes everything. And after working with thousands of advisors and agents over the past decade, I realize most of them are responding to this economics problem the only way that they can. They can't afford to advertise. Not really, right? Not until they're sitting on $40 or $50 million plus in AUM with surplus profits above what they need to live. So until then, they invest the one resource they have, their time. Cold calls, LinkedIn messages, asking for referrals, grinding it out one by one, hoping the compounding eventually kicks in. And because they need the payoff, they lead with the big ask, which is give me all of your assets, because that's the only way you get paid, right? And that's exactly what creates resistance. I watched this pattern play out over and over. The clients were interested, the offer fit, the strategy checked out, yet nothing moved. That's when I stopped asking, why didn't they buy, and started asking, why didn't they trust? Because when you lead with the wrong ask, even if it's a good strategy, you create friction, not because of what you're offering, but because of when you're offering it. And in this video, I'm going to show you what happens when you fix that sequence, how it changes the flow of trust, and why most advisors are accidentally building their business in reverse. You see, leading with AUM is kind of like proposing on the first date. I know that sounds dramatic, but let's be honest. You're asking someone to trust you with all of their life savings before they've experienced anything about what it's like to work with you, before they've felt your process or seen how you think. And when that's the order, most advisors do the same thing. They overcompensate, right? They spend more time warming the relationship. They add more touch points. They do more work up front to make the client feel comfortable. And because there's no invoice, it's easy to overlook. But that time still has a cost. You're investing real energy today for the possibility of getting paid later. Sometimes that works. The assets actually come over and everything lines up. But sometimes it doesn't. And there's the part that nobody loves saying out loud. When the client never moves the money, you didn't just lose a sale, you worked for free. All of those meetings, all of those plans, all of that follow-up for nothing. That's the real drag, not just the lost time, but honestly, it's the lost energy. And once I saw that pattern show up enough times, I started paying attention to what actually worked instead. And it wasn't more marketing. It was a structure I started calling the cash flow flywheel. Here's what most advisors miss. The AUM model doesn't just create an economics problem, it creates a positioning problem. When you lead with, let me manage all of your assets, you're asking for everything, all their money, all their trust, all at once. And when it works, even when you close that client, the ROI is still bad. The math we talked about in the intro, right? It doesn't change just because you got a yes. So you're fighting uphill to close a deal that still doesn't make economic sense. The cash flow flywheel works differently. Instead of asking for everything, you solve one acute problem. Not let me manage your retirement. That's too big, too abstract, too much trust required up front. Instead, you have an income gap. Let's solve that. Or you're worried about outliving your money. Let's fix that first. In my experience, there are really 4 problems that create urgency. Income gaps. They need reliable cash flow and don't have it. Safety. They can't stomach another 2022 or 2008 or 2001. Legacy erosion. They're watching what they built slowly disappear. Or tax bombs. They're sitting on deferred money that's about to explode. When you solve one of these with a portion of their assets, not all of them, two things happen. First, the resistance drops. You're not asking them to hand over their life savings. You're asking them to solve a problem they're already losing sleep over. Second, you actually get paid. Not someday. Now, let me show you what this actually looks like. I know an advisor who was licensed and independent for 10 years, and after a decade of building his practice, he only had $15 million in AUM. That's it. Not because he wasn't good, not because he didn't work hard, because he kept chasing the big ask. Give me all of your assets. And fighting the resistance that comes along with that. Now compare that to John. John doesn't lead with AUM. He leads with solving one problem, usually income or safety. He positions annuities as the solution to that specific pain point. In his first year as a licensed advisor, he brought on $6 million in assets. Where do you think he's going to be over the next 10 years? Probably 10 times the other advisor who only had $15 million after a decade. Same industry, same licenses, completely different approach. John isn't asking for everything. He's solving something specific, and that changes the whole dynamic of your conversations with new clients. You might be wondering exactly how he does that. Well, stick around to the end of this video and I'll give you a training on the step-by-step process, which brings us to the next question. What actually solves these acute problems? Well, for a lot of advisors I work with, the answer is a properly structured, best-in-class indexed annuity. And yes, I know that just made Dave Ramsey's eyes twitch a little bit. So let me show you why this is actually the right thing for your clients first. And then I'll explain why it happens to be good for your business too. This isn't about what's good for you. It's about what's good for your client. Because if it's not right for them, none of this really matters. So let's start there. For decades, bonds were supposed to be the safe part, the protection, the thing that was supposed to zig when equities zagged. And then in 2022, something happened, right? Stocks dropped and bonds dropped with them. And advisors, well, they had to make phone calls they never expected to make, explaining why the safe part of the portfolio was down double digits. The 60-40 didn't just underperform, it betrayed the people who trusted it most. This wasn't a fluke. Nobel laureate Robert Shiller called it. We've seen the 40-year bond bull market end, and that changes everything about the traditional 60-40 portfolio, is what he said. The math shifted. Rates rising from historic lows mean bond values fall, and the correlation that used to protect portfolios, well, it's broken. That's not an opinion. That's just how bonds work in this environment. So what actually belongs in the safe part of the portfolio now? Well, for clients in or near retirement, it's an instrument that can guarantee income regardless of market condition. It can eliminate downside risk entirely and provides lifetime certainty, not just historical correlations or uncorrelations. That's not a bond. It's actually a best-in-class indexed annuity. Done right, annuities solve for the one thing retirees actually lose sleep over, which is certainty. Not upside, not beating the S&P, certainty. Now picture this, a 62-year-old couple sitting across from you. They're not worried about alpha. They're not asking about sector rotation. They want to know, will the income show up when it's supposed to? If the market drops next year, will the plan still work? If one of them passes away, will the survivor be okay? When you solve for that and those problems, when you take that fear off the table, they don't just say yes, they actually exhale. That exhale, that's the moment you stop being a financial advisor and become their most trusted advocate. Now, here's what's remarkable about this approach. When you lead with what's genuinely best for the client, the economics, they actually happen to work for you too. You're not asking them to move all of their life savings to someone they just met, especially on the internet. You're solving their biggest fear right now with something that has real teeth. And yes, you get paid for that value that you create. That's not a conflict, that's alignment. The right thing for the client, though, is also the thing that makes your business mathematically sustainable. Now, of course, not every annuity case turns into AUM. Not every client consolidates all their assets with you. That's not the point. The point is, you're finally getting paid to do work that matters. And that early revenue, it covers your acquisition cost while putting profit in the bank. That's how this becomes a real business, not just a bet and a hope. So the real question you should be asking yourself now isn't, should I use annuities? It's, what's the first problem that I'm solving in my process? If the answer is income, risk, or retirement certainty, then annuities aren't a pitch, they're the solution. They prove your value. They earn trust. They fund the relationship and the acquisition of new clients. And once that's working, everything else, the consolidation, the AUM, the referrals, it becomes a lot easier. That's the shift I want you to see. This isn't about selling annuities or getting more assets under management. It's about building a business that pays you early and earns trust faster, finally feeling sustainable for you. And it also is scalable at whatever pace that you want to grow. Now, if you're wondering what happens after the annuity sale, how you actually convert that trust into AUM without feeling pushy, I made a video on that. It's called the Counterintuitive AUM Strategy, and it explains why the fastest way to grow your assets under management is to stop asking for all of their assets and really stop asking for AUM at all at the beginning of your relationship. So click here on the screen and watch that next. Or if you want help in putting this whole system together, you can learn more at the link below. I'll see you in the next one.